Good morning, students. Today we will be discussing December 2021 CA Sri Lanka's Corporate Finance and Risk Management questions. Actually, there are 3 questions, as you know. Question 1 and 2 has 25 marks each, and the third question is on the case study, which is 50 marks question. So, I am sure like all of you all have experience of the previous past paper questions. So, today initially I will take question 1 and 2, and then we will be discussing in detail, and as you know there are suggested answers for these questions. So, we will be taking through the question paper while the suggested answer also on the screen, so that it is easy for you to understand, and any clarifications on the matter or the topic or the theoretical area, I will take it separately and explain while we are doing the question. So, let me take the paper. So, we take question 1. This is about Cocoa Lanka PLC, leading manufacturer and exporter of coconut based food and beverage in Sri Lanka. Recently, company conducted a market survey on new product developments in order to start a new project. Accordingly, a strategic decision was taken to produce coconut ice cream, which requires an investment of 165 million for plant and machinery. And they have given you the project details, where the investment is 165 million and the 5-year project, and the cash flows, expected cash flow for 5 years is given in the table. Further, they say there is 8 million investment on working capital, which will be financed from retained earnings, and then project end you will be able to realize the working capital as well as the capital expenditure what you incur. So, capital expenditure what you incur will be realized at the rate of 16.5 million, and the current tax rate is given as 14%, and the company is able to claim capital allowance at the rate of 25% on straight line basis. The tax will be paid in the same year in which the profit is earned. If there is a tax losses, it will be carried forward to next year. Risk-free rate is given at 4%, and beta factor of the company is 1.2, expected market return is 9%. So, when you read this information, you automatically will start thinking what are the chapters or the areas you have learned which are relevant towards this information. They further say the company is going to finance the project investment 60% from the subsidized loan facility from the Export Development Board for 5 years, which will be repayable in equal annual installments at an interest rate of 9% per annum. The current market borrowing rate is 15%. So, please understand, the Export Development Board is giving you, because you are an exporting company, they are giving you a loan at a concessionary rate of 9%, whereas the market rate would have been 15%. If you are going and taking a loan from the market on a normal basis, you would have been paying at 15%, whereas Export Development Board is giving at 9%. The current market rate is 15%, and the company is expected to offer right issue to its shareholder to finance the balance part of the project. So, we know that total investment 60% is financed by debt capital, 40% is financed by equity capital. Then they say the issue cost will be 6% and it will be allowable as deductible expenses. So, this is basically the investment appraisal information the question had given, very basic information has been given. But the question is, the Chief Financial Officer of the company, you being the CFO, advise the Board of Directors of the company on this investment decision using the APV method. So, they are not asking you to calculate NPV of the project, they are asking you to calculate the APV of the project. So, you need to be aware, the NPV method, you will straight away take your cash flows of the project and evaluate using the cost of capital of the project and say the NPV is positive or negative, whether to accept or not accept. But in APV approach, I am sure you would have learned APV approach as a basis or maybe the steps involved in calculating the APV. That is, you calculate the APV by taking the project cash flows and considering the project is funded or assuming project is funded by the cost of equity or the equity capital. So, you calculate your project NPV on the assumption that company is funded 100% by the equity capital. After you calculating that NPV, it is called base case NPV. After you calculating that, you will be assessing, you will be calculating and assessing what is the impact of the side effects. What are side effects? If you take this company project, this company is going to use debt capital. So when we use debt capital, there is always a benefit of tax saving on the interest. All of us know that when you borrow money from bank or any other institution, that interest cost will be deductible against the taxable income. So therefore, when I use the debt capital, I am able to get tax benefit on my interest of the debt capital. So when you understand this question as 60% capacity, 60% financing by debt capital, you need to calculate what is the interest cost and what is the tax saving. Not for 1 year, it's about 5-year project and your loan is going to be 5 years, so you find out what is my tax saving for the 5-year period. Since the period is more than 1 year, always remember that you need to calculate the side effect in terms of the tax saving in present value form. So we will do that. Further, if you look at it, the project has issue cost. That is another side effect of financing. So you need to find out the impact of the side effect of share issue cost. Third, you have been given a loan by the Export Development Board at the rate of 9%, whereas the market rate is 15%. So there is a 6% benefit the company get because of the Export Development Board concessionary loan. So you need to find out that also coming as a side effects of financing. So side effect you calculate that separately and you need to make an adjustment for your base case NPV. Okay. So on that basis, it's a 15 marks question. If you are aware of the APV concept properly, it's not difficult for you to get these marks. So truly speaking, study pack, always we say that Chartered Institute has very comprehensive quality study pack for the students who are doing chartered exams. So that study pack definitely will be useful if you have gone through it properly. So when I go to take the suggested solution, we'll move on to the suggested solution. If you look at the suggested solution, it has the study pack reference, page 290 to 297, basically which covers the APV approach. I'm sure like if you go through that, because the English is not so difficult, it's easy to understand and it's very clearly mentioning the each and every step of the APV calculation. Different side effects have been explained. So anyone who is doing this question, before doing the question, just go through that APV concept in the study pack and make sure that you are clear about it. Then you start looking at it, that I think you will get the most of the marks of the question. 15 marks question, you can easily get 10 to 12 marks because it's very straightforward, like if you look at the study pack. That is the advantage of you going through the study pack on a regular basis of all the chapters, because that has a good material and you will learn a lot. You will definitely learn a lot, and by doing the exercising based on the questions what is given in the revision kit or even other past papers, you are able to get the reasonable knowledge to get through the exam. Okay, so now we go to the question. As I mentioned that we will be talking about, before I just get to the numbers, I just show you the APV concept calculation. Now you will see that finally the answer going to be your base case NPV. You will be calculating the base case NPV. Then we calculate side effects of financing. So as I mentioned, effect on subsidized loan, effects on right issue. So you will have those two side effects. We will look at numbers, but before that I just want to give you the overall view of the APV. So you get the base case NPV, as I mentioned, you will be calculating the base case NPV on the assumption that your entire project is funded by the cost of equity capital. So you will be discounting your cash flows by the cost of equity. So that is what base case NPV is going to be. So you calculate that, then you calculate the side effect of financing. Then you will be able to get the adjusted present value. So this is the answer. This is going to be the answer. So before going back to the answer, we start from the starting point, which is your base case NPV calculation. Base case NPV calculation. So you can see here, the project cash flows are given in the question. Initial investment going to be 165 million. Initial investment going to be 165 million in year 0, and the investment will be realized at the end of the project period, which is 5 years. You are told 16.5 million will be the realization of capital expenditure at the end of 5 years. So that basically your investment cash flow and the realizable cash flow. Then the working capital investment. They have mentioned the working capital investment going to be 8 million and which will be recovered at the end of the project. So that is basically given. Cash flow before tax. The table in the question, cash flows are given. Year 1 to 5, what is the cash flow going to be received from the project? Then if you look at it, other than the cash flow what you talk, the cash flow going to be tax payment. So when I go to tax payment working, you can see the 5 cash flow before tax. So it's actually the profit liable for tax. So you take that 1 to 5 years, you can take it from the table what you talked about earlier, and the residual value 16.5 million of your capital expenditure. They mentioned that your project is able to claim capital allowance at the rate of 25% on straight line basis. So 165 million can be claiming capital allowance over the 4-year period. So it's equal 41,250,000 for 4 years. So you get the net, actually it says a cash flow, it's actually net profit liable for your tax, You will see that first year you have 1,250 or 1,250,000 as a loss. So you don't have any taxation for year 1. I'm sure everyone can understand that. Year 1 no tax. But the tax losses for the year 1 can be carried forward to next year. So that is, you can see that tax losses claimed in the second year. So second year, again the same calculation, you have a profit which is given already, and your capital allowance and your net amount of profit, and you claim against your tax what you had carried forward losses. So then your 250,000 is your taxable profit, even though they say cash flow, it's cash flow as well as profit in this case, right? So it's 250 into 14% tax rate. It's not 28 or 24, it's 14%. So your year 2 going to be 35 million or 35,000. Third year is straightforward, third, fourth, fifth year. Only thing, please remember the fifth year you have the residual value of your capital expenditure. Actually your capital expenditure is 165 million. You are claiming capital allowance for 4-year period. So year 1 to 4 year, once you claim and finish your capital allowance, your net written value for the tax purposes is going to be 0. Net written value for tax purpose is going to be 0. So when you sell your asset or capital expenditure, when you realize, you get 16.5 million, which does not have any tax written down value. So the entire 16.5 million is the profit you make from your taxation calculation. So that's basically this working. Then you can see that the tax, this actually working number 1 basically shows the tax calculation. You have the capital allowance and you have a residual value, and your tax losses for the first year can be carried forward to year 2. Then your tax liability has been calculated at 14% for year 1 to 5. Year 1 having a tax loss, no taxation. Year 2 to 5 is there. So this is basically the working 1 which is taken into your cash flow statement. You can feel that year 2, 35 million, 35,000, 266,000, so it's there. So when you take this calculation, you have got your cash flows. The next question going to be, I have to discount my cash flows to evaluate the present value. So if I go to look at the cash flows, this is what basically reflect the cash flow, 173 million, and then all these cash flows. What is the cost of capital I have to use? I mentioned to you, if it is an Npv approach, you would have taken WACC and calculated our Npv of the project. But it is going to be Apv approach. Apv approach, first step is that you calculate the Npv of the project on the assumption that your project is 100% funded by equity capital. Even though this project has 60% debt capital, but the assumption for the Apv approach, you assume your entire project is funded by equity capital. In that case, your cash flows, what you calculated, has to be discounted not at WACC but at cost of equity, because the assumption is your project is 100% equity financing. So what is your cost of equity going to be? As you know that they have given you some information to calculate cost of equity under CAPM model. Cost of equity is a working number 2, right? It's about ungeared cost of capital, ungeared cost of equity, because you are assuming that your project is funded by equity capital. On that basis, all of us know that under CAPM model, when you are going to calculate, you know that your cost of equity equals to risk-free rate plus beta market return and risk-free rate. So, this is a CAPM model, CAPM model. So, all of us know that under CAPM model we are able to calculate cost of equity. So, the cost of equity or the expected return on the other side, because there are two sides of it, investor point and the company point of view. So, we generally take the cost of equity from the company point of view. So, if you go into calculate cost of equity, risk-free rate plus beta into RM minus RF. So, this RM minus RF is the risk premium, risk premium. So, when you multiply the beta by the risk premium, you get the risk premium specific to this company, risk premium specific to company. So, the investor want that kind of risk premium to invest in this company. So, when you add the risk-free rate with the risk premium, what you get is the expected return of the investor, or on the other side, cost of equity. So, what I want to tell you is the cost of equity has to be computed from CAPM model, this is a CAPM model. So, when you calculate the cost of equity, it is going to be 10%, So, 4% is your risk-free rate, beta is 1.2 and your risk premium is 9 minus 4, 5%. So, basically your cost of equity, ungeared cost of equity is 10%. So, when you use that cost of equity as the cost of capital of the project, you would see that your discounted cash flows year 1 to 5, year 0 to 5 and your base case NPV is 2319 or 2.3 million. So, this is a negative NPV, please understand this. When you calculate your project based on cost of equity, that is assumption we are using for the Apv approach, your project is not viable as it looks like, because NPV is going to be minus. But you need to understand this is the base case NPV. Then we need to calculate side effects of financing. So, what are the side effects this project has? There are three side effects this project has. Firstly, we look at your project is funded by debt financing by 60%. So, 60% of your project is funded by debt capital. So, as I mentioned at the beginning, when you use the debt capital, always you have a benefit of tax saving on your interest, So, 60% of your project, as I mentioned, 60% of project is funded by debt capital. So, we will go to look at that side effect of financing computation. So, you see that your 165 million is your project investment, 60% is your debt capital. So, you calculate your component of debt in financing your capital expenditure, and you calculate what is your installment going to be for the 5-year loan you are going to take from Export Development Board. Since the installment is going to equal annual installment, you are going to pay over the 5-year period, you calculate what is your installment value, and the rate of interest is 9%. So, you can see that the tax relief, before coming to tax relief calculation, your equal installment has to be calculated. So, the formula is value of an installment equals to the loan you take divided by the relevant annuity factor. So, the value of an installment equals loan amount, which is 60% of 165 million divided by relevant annuity factor. Whenever we calculate relevant annuity factor, two things to be taken. One is the interest rate and the period. Period going to be 5-year equal annual installment and the interest rate going to be 9%. So, on that basis you calculate your annuity factor and find out what is the equal installment. Equal installment going to be 25.4 million, which is the equal annual installment, which means the installment considers or includes capital part of it and the interest part of it. So, both together 25.4 million you need to pay annual installment to basically settle your loan. So, you can see the loan repayment schedule. You have taken 99 million loan year 1 beginning, and you have to pay 25.4 million all these 5-year equal annual installment, and then you calculate your interest component, that is 99 million into 9%, 8.9 million. So, out of 25 million installment you are going to pay, 8.9 is your interest component. Then automatically the export development will recover 16.5 million from your capital, because you pay equal installment of 25 million. That has two components, interest and capital. Interest is calculated on the loan outstanding at the beginning. So, 9% of the loan outstanding at the beginning is calculated 8.9 million. So, 25 million when you repay installment, the export development will take 8.9 as interest, balance as a capital. So then your closing balance is there on the end. That becomes the opening balance. Again, you calculate the interest for second year at the 9% of the opening balance. That is going to be 7.4. Anyway, you are going to pay 25.4 million annually. So when you do that, your capital again going to be 18 million. Please understand the loan repayment schedule. Always when you pay equal installment or installment, the interest component slowly reduces. You can see that, slowly reduces. But the capital recovery by the institution or the bank will be increasing. Why? Your installment is equal annual installment which is equal, then your interest component is reducing because your loan outstanding is reducing. Loan outstanding is reducing. So when the loan outstanding reduces, interest component reduces, but the capital component increases, recovery point of view. So basically you will see that if you are going to pay equal annual installment of 25.4 million, closing balance of your loan is basically 0. So if you calculate your equal annual installment properly, right, taking the right annuity factor, you will see that your closing balance has to be 0. If you are having a balance outstanding, that means your installment calculation is not correct. Please be aware of that. Then moving on, so you have got your loan repayment schedule. The purpose of calculating loan repayment schedule is to find out how much the interest component going to be. So then you can see the next table which has year 1 to 5, your interest component which is basically year. So the interest amount, as I mentioned, since the tax division or inland revenue basically give you the benefit of tax for the interest payment. So your amount of interest going to be claiming tax benefit. How much rate? 14%. So these are the 14% tax benefit on your interest for year 1 to 5. Since your project is funded by debt capital, you are entitled to tax benefit on your interest year 1 to 5. Then you need to know these are the year 1 to 5, not today. It's not today benefit. It's going to be over the period benefit. So as we know the financial management, we have time value of money consideration. So I can't take this cash flows what I'm going to get tax relief year 1 to 5 as today's value. I can't take it because these are different time period. So I have to bring this benefit to today's value. How do I do that? I calculate present value of these future cash flows. I need to bring the future cash flows into today's value, that is the present value. So how do I do that? I want to discount these cash flows to get the present value. Now the question going to be, what is the relevant discounting rate to get my present value? Please be aware, even if you look at the study pack, you will have that there are two approaches you can take. One is the risk-free rate. If you are going to discount your tax relief, you can take the risk-free rate and discount and say this is the present value. Or alternatively, you take another discounting rate, the 9% discounting rate, which is basically the export development fund cost of capital. You may use that to calculate the present value. But even though there are two choices, I am taking here, or the suggested answers are taken, is a risk-free rate. Even the some of the textbooks recommend the risk-free rate to be taken. But it's not wrong for you to take 9% also, your discounting rate, but risk-free rate is more preferable. So we take the risk-free rate and multiply the tax relief and get the present value of the tax relief. So what we are doing here, because of the debt financing, this company will be able to create wealth, create value of 3.6 million. Because of debt financing. This is the beautiful nature of Apv approach, which shows you the benefit of your debt financing. Because when you take normal NPV calculation, you put all the cash flows together and calculate by WACC and get the NPV project. But it doesn't know, or you don't get the idea, what is the benefit I got from the debt financing. But Apv approach very clearly identify and show you, look here, because you use debt financing, you are creating wealth for the shareholders, 3.6 million. So simply please understand the benefit that you are going to get is the tax saving on interest of the debt capital. Tax saving on interest of debt capital is the benefit you are going to get. Since the tax saving is year 1 to 5, you can't just add and say these are tax saving. It is not accounting, it's financial management. So financial management point of view, we always say that time value of money is important. So this 1 to 5 year period cash flow what you are going to get as tax benefit, you need to bring it to year 0. So year 0 value you need to calculate by calculating the present value. So that is 3.6 million. So please note The base case NPV you calculated was 2.3 million minus. So according to the initial evaluation, you think that project is not viable. But now we are taking side by one to say that, okay, you have a tax benefit because you have taken debt capital and you are 3.6 million, you are creating wealth for the shareholders because of debt financing. So you can see the impact of NPV 3.6 million. Then going to be benefits of the lower interest. Your company was able to borrow money from Export Development Board at a concessionary loan at 9%, whereas the market rate is 15%. So you are getting a 6% benefit. So that is also another side effects of financing, So we take that benefit separately and show this is the benefit you are getting because you got it at concession. This is not the same thing for another company. Another company may not be able to borrow at 9% even when the market is 15%. So your company is able to get it. So you are showing the board of directors or the management, look here, because we got a loan at a concession rate, we have a benefit of so much. So what is that benefit? So please look at your 165 million loan. 60% is the debt component, 165 million is the capital total expenditure, 60% is your loan component, and the gap between your market rate and the your borrowed rate, that is your 9% concessionary rate. So you take the gap between those, this is the benefit you are actually getting. So 6% against your debt capital will give you the annual interest saving because of your concessionary loan. But the saving is also liable for tax in that case, so you find out what is your tax impact. So on that basis, you see that benefit of lower interest rate, net of tax, benefit of lower interest rate, net of tax 5.1 million. So that is for 1 year. Since the loan is there for 5-year period, we are calculating 5.1 million for 4-year periods or 5-year period. But we are taking again, as I mentioned, your risk-free rate of 4% is taken to calculate the present value. So see 5.1 million for 1 year benefit, you are going to talk about 5-year benefit into the 4% discounting rate, which is your risk-free rate. So on that basis, your benefit is going to be 22.7 million. So your subsidized loan, there are two benefits you are getting. One is the tax saving on your interest at 9%, which is 3.6 million what we calculated earlier, plus your reduction in interest rate 15 to 9, that is the benefit you are getting. Net of tax, you get 22.7 million. So total 26 million you are getting benefit because of the debt financing. Because of debt financing and more than debt financing at a concession rate debt financing, you are having a benefit of 26.3 million. Then the next item or the next side effect is going to be issue cost. As they mentioned in the question, 165 million is the capital expenditure, 60% they are funding through debt capital, 40% they are going to fund through the right issue. Even though the working capital is funded by retained earning, we are not interested about whether there is no issue cost or debt financing impact. But your 40% 165 million going to be raised from the right issue. So right issue, there is the issue cost you have to incur to get the money from the shareholders, which is 6%. So how much is your issue cost going to be? 165 million into 40%, which is your right issue amount, into 6%. But please note, this issue cost is not that exactly same amount. Why I am saying is, because if you are going to you want 165 million into 40%, 165 million into 40%, that's your equity or the right issue money you need. That money you have to pay the issue cost 6%. So how much net amount you get? 94%. So the 94% is not sufficient for your 165 million 40% because you need that money. So when you calculate the real issue cost, the 165 million into 40%, which is the amount you are going to raise, which is the 94%. It's not 100%. If you consider that as a 94%, how much your issue cost is going to be? 4.2 million. So please note, issue cost 6% on the 40% loan or right issue will be lower than this. Why? Because that is the right issue money what you are going to raise has to cover the issue cost also. That means you have to raise the money from right issue, not only the money what you need plus the issue cost money also you have to raise from the right issue. Then only you can cover the total requirement of capital. So on that basis, it's 4.2 million. That's why it was deducted divided by 94%. So tax effect on issue cost is going to be again 4.2 million into 14%, 589. It's only one period. That is at today's period. That is year 0. Your benefit going to be, or not benefit, the cost going to be 589. So these are the side effects from the project what we are talking about. So on that basis, moving on, you can see that your base case NPV, 2.3 million negative. As I mentioned earlier, by looking at the base case NPV, your project doesn't seem to be viable because it's not creating wealth for the shareholders. So NPV minus main project is not acceptable because you are not creating value, you are destroying value. So you may not take this, you might not take it. But please note, since you are financing through debt capital, you are going to get benefit for the shareholder. So how much is that benefit you going to be? 26 million benefit. 26 million benefit. There are two components in the benefit. One is the interest on the debt capital is getting a benefit of tax saving. Second, you have got a concessionary loan. That benefit also we have calculated separately. So accordingly, 26 million you are getting a benefit. Then the right issue when you use, your right issue has an impact or issue cost of 3.6 million. So finally, adjusted present value is 20 million, which is a positive NPV or positive value creation. So you will accept the project because at the end of the day, shareholders wants to create wealth. That's their primary objective. So primary objective of any corporate is to maximize their wealth. So 20 million you are creating. So the APV approach I have given you specifically what is the NPV of your funding through equity capital, what is the impact of debt financing, what is the impact of share issue. All that is separately given, and finally your project is viable because it gives you 20 million positive NPV. So this is basically the APV approach. As I mentioned, the examiner has given the discounting rate instead of 4%. If you are using 9%, what is the impact separately? Because some people might be using the 9% as a risk-free rate or maybe discounting rate. So you have an alternative answer also. So we have taken risk-free rate. I think that's more comfortable. But if you have taken 9% also, the marks will be given because that's basically allowed in the question. So you can see that. So both cases you see that the adjusted present value is a positive number. Adjusted present value positive number. That means you will create wealth. You will create wealth. This is 15 marks. This is basically if you have gone through the study pack, APV approach, the area, this is just modest marks for you, right? You won't get any excitement in the exam hall because this is very straightforward and step by step, even study pack has step by step area, what is the impact of subsidized loan, what is the impact of the tax saving on the debt financing, what is the issue cost impact, all that is separately given. So basically this is the APV. Only thing when you are looking at the side effect of financing or debt financing, I think maybe someone will say that your debt financing subsidize, when you subsidize, you can see here, 165 million into 60%, the gap is 6%. So 6% benefit you are getting, 6% benefit you are getting on your loan of 60%. And the tax impact is also there. But please note that the 6% impact as per the answer, and you would have taken this number, is 5.1 million per annum. And we calculate the present value for the 5-year period at 5.1 into the annuity factor. Actually the 5.1 million is your first year benefit. Right? Second, third, fourth year, fifth year, the benefit will come down. Why? You are going to repay your loan annual installment. If you don't repay your installment for 5-year period, this is the exact amount of benefit. But if you are going to pay equal installment annually, you will realize, like what we looked at the beginning, loan repayment schedule, even at 15% loan repayment schedule, you need to find out what is your interest going to be. So you take the gap of interest at 15%, what is your interest, 9% what is the interest, that gap, and calculate this calculation. So that would be a more appropriate calculation, right? But for simplicity, the registered answer also taken at for 60% 165 million, and the 6% gap. The 6% gap is definitely there, but not under 65 million into 60%, 6% gap for the entire 5 years, because we take for 5-year benefit. 1 year benefit, yes, it's 5,108. After that, the benefit will come down because your loan repayment will reduce your interest component. You can see that here. Your interest component first year would be 8,900, but last year it's 2.1 million. So even whether you are taken at 15% or 9%, your interest, when you are going to repay equal installment, your interest annually will come down. Interest annually comes down. So when you say that interest is going to come down, the benefit you get because of a concession loan is not 15 minus 9 into the loan capital outstanding. No. Capital outstanding of each year, not at the beginning, because each year you are repaying the loan. So please consider that impact, even though the suggested answer doesn't consider that, but you should be aware its actual calculation has to be the gap between those two for the loan outstanding, like here, each year loan outstanding. So you prepare another loan repayment schedule and calculate the gap. For the simplicity purposes, we have taken that total outstanding at the beginning on which the calculation is done, and you have taken a benefit. So it's more than just numbers. Please aware of the Apv approach and how the impact is calculated, and it's a very good approach because it shows you the benefit of each and every side effect. So the company can decide whether I should borrow more or less and what is the benefit I am going to get in my project. If I just look at my equity funding of this project is not viable, it's negative NPV. But because I use debt financing, I am getting a benefit to my company because debt financing has tax saving on interest for the period of the project. Okay. That's your question number 1. A part, 15 marks. Then moving to B part. The B part is on the foreign currency management. B part is on foreign currency management. You can see it's about Serendip PL Private Limited exported products to US market at the beginning of 2021, September, and they are expecting $800,000 on December 20th, 2021. So basically 3 months time they are expecting the export proceeds of 800,000. Company expects the dollar price to drop. So dollar price to drop at the end of the year, and therefore is considering hedging the foreign exchange rate using following 2 hedging techniques. So it's about foreign currency risk management. It's about simple example. They are saying a company in Sri Lanka has exported goods to US and the invoiced amount is $800,000, and they expect the dollar to drop. So they want to take risk management approach. They are going to look at 2 options, currency option and forward exchange contract. So as you know, these are the techniques available to minimize the exchange rate risk. Apart from there are many techniques, but these 2 techniques are also available. Only thing, before going into the answer, let me ask you, what is the difference between forward exchange contract and currency option or the option contract? The forward exchange contract is a binding contract. It's a binding. You and the bank agree that how much dollars you want to buy or foreign currency you want to buy on a future date at an agreed rate. So you get in a binding contract or agreement with the bank, and the bank will say, okay, this is the agreed rate. I will give you dollars of $800,000 on December 20th at the rate of 220, something they can agree. So that agreement is going to be binding on both party, Whether it's a bank or a customer, both parties are bound by the contract. So you cannot deviate from your contract obligations because you are supposed to follow the compliance of the contract. So you have the right and obligation in that contract. That's the binding. But option contracts are not like that. Option contracts gives you the right but no obligation. It gives you the right, no obligation. Which means when it comes to the 20th of December, the day in which you want to exercise your option, you have an option of or the choice whether to exercise or not to exercise. If the market condition is favorable, you go with the market. If the market condition is favorable, you go with the market. You don't worry about what is the contract of option. You don't have to think about option contract. You can just ignore the option contract. But forward exchange contract, you are bound. You cannot escape from that because bank will say, no, look here, you agree with me, please buy the dollars. Please buy the dollars at this rate what you agreed for. But in option contract, it's no compulsion, it's only right, no obligation. So this is a theoretical knowledge, you have to be very much knowledgeable. Right? Before going to calculation, basic idea of your theory has to be clear. that forward exchange contract is binding, option contract is not binding. So the advantage in option contract is when the market conditions are favorable, you can ignore the option contract and go ahead with the forward market rate. But forward exchange contract, you don't have a choice. Even if the market condition is favorable, you are bound by the contract. You have to buy the dollar at the rate which you agree with the bank. Okay. So on that basis, we look at this question. There are two options. Currency option, the option contract, the company is buying $12,000 option with a strike price of $1 equal to 210. Cost of the option is $100. So you need to understand that it's all like a packeted or packaged. $12,000 option you have. We are requiring $800,000, but 12,000 is the one bag if you take. So you are buying 12,000 at $100 as the nominal price you have to pay to buy the option contract. Please remember, the option price you pay is a sunk cost. For the decision making, you don't consider that. From accounting, gain or loss calculation, we will calculate. But the decision making point of view, this is not important, it's a sunk cost. Forward exchange contract, you can enter with the bank for 3-month forward rate at 208 rupees. So please see that difference. Option contract you have got, it's at 210. Forward exchange contract you have opportunity at 208. So these are two rates given. Question is, on September 2021, SPS decided to go ahead with the currency option instead of the forward contract. So the company have now decided, without forward exchange contract, we go with the option contract. So company decided, in order to hedge the foreign currency risk. So in order to hedge the foreign currency risk or as a risk management approach, company is going with the option contract. So they have the right, no obligation. Please remember that. They have the right, no obligation. It's not like a forward exchange contract. It has more flexibility compared to forward exchange contract. Where the spot rate will be $1 equals to 205. So at the moment, the dollar rate is 205 rupees. So this is in September 20th. However, if the spot rate in December 2021 20th is 216. So the actual rate going to be in the market 216. SPL does not wish to exercise the currency option. Advise a decision taken by SPL. So now please remember, you are talking about $800,000 export proceeds. You have opportunity of selling that $800,000 export receipts. You are going to get $800,000 on the future date. Future date is 20th December 2021. So now we look at what are the options you have got in terms of so you can see that number of option contracts you have to buy. Since $800,000 is the total amount of export proceeds you are talking, $12,000 is basically available in one contract. How many contracts you have to buy? 66.67. So approximately 67 contracts you have to buy. 67 contracts you have to buy in order to buy $800,000 or in order to sell the $800,000 on the future date. Cost of the options, you are buying at 67 contracts, one option contract is $100 and 205 is the today's spot rate, that is September 20th, your spot rate is 205. Actually you are spending 1.3 million or 1.4 million, you are spending to buy the option contract. As I mentioned earlier, this is the cost you are incurring to buy the option contract and this is going to be a sunk cost. From accounting you will record it, but from decision making point of view it's a sunk cost. Keep that in mind. So 1.3 million has been spent. Strike rate, according to option contract, the strike rate is 210 rupees. Spot rate on the December 20th, the spot rate is 216. So look at the various alternatives you have got. If the option is not exercised, so we will go to this, amount to be received if no hedging. You don't do any hedging. You don't do forward exchange contract, you don't do option contract, you basically just wait, get the export proceeds of $800,000, go to the bank and say, this is $800,000 I have got. Can you please give me the rupee? So bank will give you $800,000 at 216, that's the spot rate in December 2021, 20th. 800,000 into 216 gives you 172.8 million. So this is what, if there is no aging, you get 172.8 million. So keep that in mind. I'll come back again there. If you have got into forward exchange contract, as I mentioned, the forward exchange contract rate was how much? Forward exchange contract rate was 208. So at 208 into $800,000, you will get 166.4 million. So that's the forward exchange contract. You didn't enter into, I'm just giving you the number. If you have entered into forward exchange contract, what is the value of proceeds you get? 166.4 million. Third, amount to be received if the option is exercised. Now see, the option contract give you the right to use or not. It's your choice. In case you have exercised on the December 20th, how much you get? 168 million, which is at strike rate of 210 into 800,000 So $800,000 into 210 rupees will be the amount to be received if the option is exercised. That is 168 million. So if you have exercised your option, you get 168 million. If you got into forward exchange, or you didn't get into, but if you have got into, you would have got 166.4 million. If you don't do any hedging, or you don't exercise the option contract, please understand this. If you don't do any hedging, you would have got 172.8 million. But since you have bought the option contract, you have done it. You already bought option contract. But you have the right you have the right either to use or not use. So you don't use it. Why? The market is favorable. So then you don't use. If don't use mean you will get as if like you have not hedged the forward exchange or the foreign exchange risk. That is 172.8. So you have got 172.8 million compared to if the option is exercised, you get 168 million. So the gain you are going to get 4.8 million. Since you have not exercised your option, by going with the market, you have got 4.8 million. But in order to buy the option, you have paid 1.3 million. The net gain you are going to get 3.4 million. Net gain 3.4 million. So here the comparison we are doing with the option contract, if you are exercised, you would have got 168 million. Even though you bought the option contract, you didn't exercise because the market rate is favorable to you. So that is the beauty of the option contract. Even though you have the option contract, if the market condition is favorable, you can ignore the option contract and go with the market. Forward exchange contract, if you are entered into forward exchange contract, you don't have any other choice but to go with the forward exchange contract rate. So you would have got 166.4 million. Since you went with the option contract, you had the alternative either to exercise or not to exercise. If you exercise, you would have got 168 million. Since you didn't exercise because market rate is favorable and you got 172.8 million, you go with the market. So the actual gain you are going to get 4.8 million. But you have spent 1.3 million in buying the option contract. So 3.4 million net gain. So this is basically the gain you get from this option contract. What is to be remembered? Option contract has the flexibility either to exercise or not to exercise. In other words, you have the right, no obligation. Forward exchange contract, you have right and the obligation. So that difference, theory knowledge has to be very clear to you. So it's always beneficial for the option contract holder to buy it because he doesn't have to worry about he can exercise or not exercise, depends on the market condition. So here 3.4 million. As I mentioned again, the cost of the option I have taken here for the calculation of gain calculation. But when it comes to decision making point of view, whether to exercise or not exercise, since 1.3 million I have spent, I should exercise. No. That is the nature of sunk cost. If you have spent something, since you have spent it, you don't go ahead with the project. Just imagine, you have done a feasibility report. We have done a feasibility report for a project. We would have spent say 5 million rupees. But the project is not viable. When you look at the project, it's not viable. But just because I have spent on the feasibility report 5 million, I don't go ahead with the project. Why? That 5 million is sunk cost. Whether I go with the project or not go ahead with the project, 5 million is gone. Same thinking has to be there for the option cost you are paying. whether you have paid or not, your decision is different. So decision making point of view, the payment what you have made not to be considered. But for the calculation of a gain or loss, that's your accounting working, we are taking how much is the gain? 3.4 million. So this is basically the first question, second part. Or 25 marks. So there are two parts of the question. One is asking about Apv approach 15 marks. Second part is on foreign currency management 10 marks. Genuinely looking at it, if you have your basic knowledge about these two topics, you are getting the maximum marks. Maximum mark you should be able to get it. Why? There is no significant difficulties in the question. Very basic question, provided you have the basic knowledge about these two chapters. Okay. So please, again, going through question, you would understand that you have to go through the study pack properly. If you have not done it up to now, please do it, because that will definitely help you. Apart from your classwork, whatever you are doing, study pack will be a bigger advantage, because CA Sri Lanka has done a very good material, right? That gives you a good knowledge about the chapters, and it's very easy to understand, and very good examples are there. So please make use of it, so that you are covering, apart from your classwork, past papers, all that, you get additional concrete knowledge on your theories. Okay.